Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy, and today we will recap what happened in February for the markets and our portfolios, and also discuss the outlook for the next several months. Cameron, why don't you kick us off with the latest economic data?
Perfect. Thank you, Kelly. Good morning, everybody. Let's start with GDP, which is the broadest measure of the U.S. economy and economic output. So from the Bureau of Economic Analysis, this is from February 23rd. This is their first read on 2022 GDP. And 2022 GDP increased at a rate of 2.1%. So that's basically right in line with what we've kind of seen from a historical norm for a mature economy like the U.S. 2% is about the historical norm, so trending in that direction. Fourth quarter GDP, this is the second read, again from the Bureau of Economic Analysis, same report. Fourth quarter GDP came in at 2.7%. So strong fourth quarter, but overall, it looks like the economy is kind of right where, from a GDP standpoint, you want it to be. If we look towards first quarter and we look at the Atlanta Fed's GDP Now projection model, this is as of March 1st. They show first quarter GDP likely to increase at an annualized rate of 2.3%. So again, right back into the area of where we would expect the U.S. economy to be growing on an annualized basis. Biggest news really for this week, the week of March 6th, is Fed Chairman Powell is testifying before Congress. He's testifying today, March 7th, and tomorrow, March 8th. And really, while a multitude of topics will be discussed, the number one issue that is going to be on everybody's mind is going to be inflation. Fed Chairman Powell last testified before Congress in June of 2022. Since then, inflation has come down for 7 straight months. So that's, in line with what the Fed is trying to do with their interest rate increases. But the Fed is really kind of in a tough position because we are seeing inflation come down. But the overall economy and the economic picture, if you look at GDP, if you look at jobs, if you look at earnings, they're all coming in relatively strong, especially on the jobs front. The only sector right now in the U.S. economy that really has been weak has been on the housing side, and you would fully expect that with the rise in interest rates. So in that respect, the Fed is doing its job, but they really are in this tough position where the economy appears to be cooling, but yet we're also getting reads that say the economy is still very strong, i.e. the consumer is very strong, consumer spending is very strong, employment's very strong. Now, the good news, and what will be a buffer, is for the first time in 3 years, the New York Fed has an index called the Supply Chain Pressure Index that they monitor. First time in 3 years, really, since the start of COVID, that their index has returned to normal. So this is a quote from Reuters. The New York Fed observation dovetails with other recent business surveys showing the bottlenecks that have dogged the global economy for roughly 3 years have finally been unplugged, with the latest improvements occurring after China ended its COVID restrictions at the end of last year. A measure of supplier delivery times from S&P Global was the most improved in February since 2009. So really, if you hear the talk from the New York Fed, they're saying supply chains are back to normal, pre-COVID levels. So now we've had a lot of this government stimulus has worked its way through the economy. You're now getting supply chains back to normal. Will that give the Fed ammunition to pause? Economists say no. We say no. Basically, everybody says no. We're still looking at the Fed meets on March 21st and 22nd, and the expectation from CME Group, about 69.4% of economists say there's a 69.4% of economists say that there's a 100% chance of a 25 basis point increase. They also believe there will be 25 basis increases at the Fed meetings in May and June, or really a total of another 100 basis points in 2023. That's kind of the universal expectation. As we see news every month, we're basically in a monthly wait and see. Every inflation number, people are going to say, oh, Fed needs to raise, or oh, Fed needs to pause. This is going to be a constant. The one interesting data point from that is that March 17th marks the beginning of the first Fed interest rate increase since we're at almost zero interest rates. So to think about how aggressively, in less than a year, how aggressively the Fed has had to move to try to stave off inflation, it really is remarkable. Historically, it's unprecedented. But at least if you look at the numbers that are coming in, it does seem like the U.S. is slowing down. The U.S. economy is slowing down. The global economy is slowing down, and really global interest rates are starting to come down back to where the Fed wants them.
Right, or go up.
Excuse me.
Yeah. So that, great points there. I agree that we can continue to see some smaller rate hikes. It's a wait and see game because the economic data is coming in pretty mixed, and you're getting swings on a month-to-month basis. The Fed's not going to move on 1 month's data. They're not going to stop changing their direction because of 1 month. There's going to have to be several months in a row. We need to see some trends develop. We're in a unique winter situation where the Midwest, obviously, we've had a very mild winter, so that's kind of changed some of the economic numbers.
Same with Europe.
Yeah, same thing.
They were looking at a near disaster if they had a harsh winter.
Right.
And they really dodged that bullet.
So, I've read articles where some of the economic numbers, obviously there's seasonal adjustments, especially at the end of the year, January, seasonal adjustments, maybe, obviously they're making the numbers look stronger. So once again, we can't put a lot of weight into what we've just seen the last month or so. It's going to be more of a wait and see. And the expectation, at least from my standpoint, is kind of more of the same. The Fed is trying to slow down the economy. What that's going to take, it's hard to say because things got so warped going through COVID. We're finally getting to a place where we were pre-COVID. Obviously, with supply chain issues, other economic numbers are just starting to get back to where they were at the end of 2019. So, this whole time we've still been kind of behind the curve as to where we were. Had a big pullback during COVID, rebound, but we're still really not to a full, to that full growth stage yet. And, is there a recession out there? Hard to say. I mean, it seems like the Fed needs to push us into recession, or that's their theory, just to slow things down. There's a lot of money to be soaked up. Consumer still sits on a lot of money. The consumer is strong. And, businesses in general are fairly healthy. So we're seeing a lot of mixed results. In the stock market, the bond market, obviously feeling pain because of rising interest rates.
But to your point on the bond market, what is good about this kind of return to normal interest rate environment, and I don't want to steal your thunder for your discussion, but as of yesterday, the 2-year Treasury was trading at a yield of 4.89%.
Yep.
So if you think about average stock market return since the Great Depression, you have to look at different numbers, and do you reinvest dividends? The return on the market has averaged about 6 to 10% per year. If you can now get 5% and lock your money up for 2 years, for people that are on fixed income, for people that are risk averse, they're finally getting real income from the bond market, and that's a great sign for investors.
Yeah, for investors and savers, this is a better environment because now we can get return on safe assets. We don't have to rely as much on the stock side of the equation, which is good. We don't have to take as much risk on the stock side to get better rates of return when now a portion of our portfolio is making 4 or 5% with zero risk. So that, I think it puts savers in a good spot. Does it reduce the chance of outsized returns to the upside? Yes, but that's not really what we're looking for. We want more consistency. High single-digit numbers is, if we can get that consistently over time,
doubles and singles pay off.
That's going to get clients to their retirements and get them to their goals. Yeah. So speaking of which, let's talk about the markets. In February, the S&P 500 was down 3.2%. We had a great January. February was kind of the give back. So like I said, S&P down 3.2%. Year to date, the S&P is still up 2.67. The Dow Jones down 4.47. So the Dow definitely felt it more than the S&P. Year to date, the Dow is now down 1.88%. The NASDAQ down 1.86 in February. Year to date, NASDAQ had a huge month in January. Year to date, up 8.53. The Russell 2000, which measures small cap stocks, February once again down 1.81. Year to date, up 7.71. On the international front, the EAFE, which is the developed world, not including the U.S., down 2.23%. Year to date up 5.65. And emerging markets for the month was down 6.54. Year to date, just above positive 0.8% to the good for year to date on emerging markets. Our portfolio is kind of mixed results. I'd say they kind of performed in line. Growth with income portfolio for the month was down 2.35%. Year to date, we're still up 2.2 in there. Big gainers, NVIDIA in February had a nice bounce, up 18.8%. Microchip Technologies up 5%. Apple picked up 2%. Laggers during the month, EOG Resources down 14.5%. That's a natural gas exploration company. Digital Realty down 9%. Disney down 8%. Year to date, our big gainers, NVIDIA, once again up 58.9%. Because of a great January and obviously a good follow-up in February. Nucor up 27%, Microchip up 16, Apple up 13.6, and Cam mentioned housing. Our Lennar Holdings up 7.3%. Laggers for the month. J&J down 12.6. Once again, EOG. It was down 12.2, and then Honeywell down 10.2. Our dividend yield portfolio down 2.9 year to date, down 0.5%. Kind of performing a little bit more in line with the Dow. Not quite as bad, but a little bit negative there year to date. One big gainer, Eaton was up 7.8%, and laggers, Intel gave up 10.7, Verizon 6.6, Southern Company down 5.9. Year to date, Blackstone had a nice rebound. Year to date, they're up 23.6. LyondellBasell up 15.6. Eaton even, once again up 11.5 year to date. UPS up 6. Big laggers, Pfizer down 20%. Southern Company's down 10.8. In our price potential portfolio, down 1.9. This is our more aggressive portfolio, so held up pretty well down in February, down 1.9. Year to date, we're still up 6, so year to date, it's chugging along for us. I think this portfolio is going to do well this year. Analog devices up 10.1 for the month. CarMax and Asbury Auto, which we sold in February. Still, we're up 5% after some gains. We walked away from them. Laggards for the month, Fidelity Information Systems down 13.6, which we actually sold. Google 9.6 to the negative, and Abbott Labs is down 7.6. Year to date, our big gainers, here we go, Asbury up 29%, CarMax up 22.3. Like I said, we sold those after kind of recovering some gains there. Analog devices up 15, and SS&C Technologies up 12.75. Big laggards, once again, another drug company in there. Abbott Labs down 7, and Danaher down 6.7. So, so far this year, the big gainers out of the more aggressive or more technology-oriented companies. Our laggards, the more defensive things that worked well last year. We'll see if that's the pendulum swinging. 2 months in doesn't really tell us a whole lot. In the small cap arena, for the month, down 1.8%. Year to date, we're still up 2% in small caps. Lantheus Holdings for the month was up 29%. Greene County Bank up 15.5. And then for laggards of the month, NV5 Holdings down 21%. We're actually well ahead in there from a holding standpoint. We've held that for a while. We made a lot of money in there. Universal Logistics down 17%. Year to date, big gainers. Lantheus Holdings once again up 44%. That stock continues to give for us. And Winmark Corp up 24% year to date. CSW Industrials up 22.3. Laggards once again, NV5 pops in there down 20%. Harmony Biosciences down 20%. So, once again, I think the portfolios are pretty much performing in line with what we'd expect. And 2 months in doesn't tell us a lot. We've had this big swing in January coming to kind of a pullback in February. This month has started off volatile, I guess is a good way to say it, back and forth. And I expect that to continue.
Well, thank you very much for the trust you've placed in Ellsworth Advisors. If you have any questions, as always, please feel free to reach out to us. We look forward to speaking with you again next month. Thank you.
Thanks.